This is London with MarketHedge. I want to talk about a bull flag. You'll see in the middle screen here on Bitcoin. We are well in the profit, over $220,000. I want to talk about how I traded this bull flag, what were the accompanying patterns, and what you can look for on the macro, on the micro, so that you can approach your bull flag trading the best. Now, the important thing that you'll see, and I have one more trade over on the side here, but as we look at the various positions, and you're seeing a descending triangle here, which was a confluent pattern, which I love to buy under descending triangles, hoping they'll turn into a bull flag with this catch. Looking at each of the specific screens, though, you're going to note one specific thing. I bought low on every single entry of the bull flag that we have. The $49,000 entry here, remember, that was low underneath the descending triangle, right? As we approach that 23.6, what did I do? I hedged in, I stacked orders, bam, below. This was where I picked up small trades, guys. Looking at this, I picked up 5 orders, 49K in the profit. Just pay attention to the overall tactic, if you would. In terms of this, looking at the 222 leverage, the $222, and each one of these 1, 2, 3, 4, 5 orders that picked up now is about $10,000 into the profit. What's the key consideration here? As we were breaking down, I was stacking orders below a bearish target. When other people were shorting, I was picking up at the lower levels. So these $98,000 entries here are really looking, guys, from $1,000 to $50,000 in terms of overall overall investment. It's a gangbuster trade. Happy to bring it to you, but what? We bought low. Now let's look at the second feature here, this second trade that we're in, which is a larger trade, but I want to distinguish it as well. What happened? We were up here in the bull flag, and remember that the bull flag is what? It's a move to the upside, and then it's a downward sloping channel, and we're looking for what? We're looking to repeat this move, right, to the upside. All right, so we'll repeat that. They say flags fly at half mast. Study your New York Institute of Finance. John J. Murphy is the best, guys, in terms of technical analysis of the financial markets. That's published by New York Institute of Finance. That's where Wall Street traders go to school. In terms of the specifics, we were where on this bull flag? Let's take a look. We were right in here. You guys remember? Yeah, we were right here. Now, I could have what? I could have, as you guys look at dangerous, high leverage, liquidations, etc. Look at this. I could have powered in and just gone long, but I didn't. Remember what I did. It's very important here. What I did was I stacked in a specific retracement. You guys know that, a Fibonacci retracement. I covered almost down through that 38.2. Period. You guys know that. So I stacked orders in at about where we were in this level, and bam, 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 bam. What happened? We covered this zone here, covered almost to that 104, almost picked up that 104, but all the trades of the orders that were placed in, just take a look at them. That for four positions now. This was at 75 leverage at $5,000 margin each. That's correct, $5,000 margin each. Now, in terms of that, each one of these trades is about $40,000 in the profit. Why is this important? Why is this important? I want to show specifically that at 75x, please pay attention. You may say, London, what does hedging mean? What's going on? What is hedging even about? Well, what it's about is the fact that if I had placed a sure long here with all of my capital, what would have happened? I would have been knocked out. I would have been liquidated. Do you see a 2% move? A 2% move at 75 leverage, I would be out of the game. You understand that, okay? That'd be over 150% of the value of that specific position if every percent we're going to move 75 points on it, right? At the 75 leverage. So looking at that, I took into consideration, I said, well, I'm going to hedge. Right? Meaning I'm going to stack orders below. I want to cover. And why did I pick the 38.2? Because based on New York Institute of Finance, we know that a 38.2 is a good pickup for what? For a bullish pattern, right? For a bull market. So I looked at that 38.2, but those came in with a consideration from the low to the high here. And again, like we picked up low in this zone. We picked up low in this zone as well. So if you're looking at 160 grand, the important thing to look at is if you had placed in a similar position, just flat out without hedging at all, without trying to get the value below, what would have happened? Well, at 75x, you would have been cooked. You would have been out of the game. Literally, you would have been busted if we put all of the capital, if I placed all the capital into this trade. okay, you would have what? You would have been out by the time you'd gotten down here. So it pushed down and it picked up orders. So that's what we're looking at is, again, a value entry on a bull flag looking for that move to the upside. So very important. Again, on the first one, we got value consideration, entered low. Second of all, as we're working our way up on hopefully that 1, 2, 3, 4, 5 up and out, right? We got what? Another value entry. Looking at the 38.2. Now I'm going to pull over. This was like just a song and dance. It was like towards the end. It was no big deal. I wanted to show you guys like, hey, we can put in 100 orders. That was important for me. Pay attention to what we did on this final trade here. Let's take a look at this. This was these were smaller entries, as you guys will recall. They were smaller entries on another account. It was a $10,000 account, right? But what had we done? We had pushed up to a breakout, and I'm like, I bet you this thing is going to pull back and test the breakout traders. You guys remember that? So when you see these specific lines, these are orders. These are either orders or positions that picked up. I put in 100 orders. I wanted to show you guys, hey, we can stack 100 orders. Let's go. Yeah. In terms of the specifics here, the low to the high again, and I was looking for a value consideration. If I drew out my Fibonacci retracements low to high, here we go. And you guys know this is London, former hedge fund owner, private, non-SEC, not financial advice. You guys know that. But what I did was I stacked in, I measured, and I said, hey, looking at this new high, which was the breakout, if the buyers get pushed around down to what? They got pushed down to that 23.6. Okay. Now, and I covered down to that 38.2. You guys remember, like if it's bullish, if it's going to get up and out, technically that 38.2 is a good litmus test for us to see that yes, it is. We're still in that bullish march. So we only got to the 23.6, but on a $10,000 account. And again, the purpose of this trade was to show you, hey, we can stack in 100 orders, hey, without exposing ourselves fully at this top line, right? And here the leverage was 150x. We put $45 in each trade. Okay, but 100 orders, granted, at 100 orders. Now the account is just as an example. Look at this at $22,000 in terms of profit. And what happened? Well, at least we can say the following. Yes, we got up and out. Bitcoin made a great move. But again, just like we did in the first trade where we were looking for value, you got it right. And were we overexposed? No, we were stacked. We had specific orders below. Right? Even on that first trade, even on that second trade, we had orders below. Looking at that value consideration, let's say on the first move, all the way down that 98K, looking for the value consideration here on that second move. After, guys, everyone's piling in, going all in, just long. Yeah, we'll catch it lower on that 38.2. Those entries from 105 to 107. So, and then that third trade, again, and just to show you guys what could be done in terms of the specifics here, these trade entries again from that low to the high, you're getting the picture, right? Yeah, this is how you trade a bull flag. This is when you say, well, I'm going to buy the dip. Well, the problem, if you're not stacking any orders and you're going all in or you got a tight stop loss, what can happen is the exchange can push you completely out, right? You guys know that all too well. It's like, well, I'm buying the dip. But I'm getting pushed out of my positions with my stop losses. Okay, well, make it more difficult for the exchange to push you out. Stack your orders below. Don't involve all your capital up top. You show up looking completely different on the radar with the exchanges when you are settled in and saying, that's fine, I'm buying lower, come get me, right? Come get my orders. When you show up and say, that's fine, I'm buying lower, come get me from this low to the high again. So as we consider the three moves now and looking at first trade, $50,000. The second trade, $160,000. Looking at that, is at 210. Yeah, 210 with the 2030. So if you're looking at 230 grand in profits, understand, first of all, this is one of the riskiest things on the planet to do, leverage trading. If you don't do it correctly, it is probably beyond the riskiest thing you could do. You guys know that. It makes no sense whatsoever. So as you're looking at a trade here at $50,000, I want you to take away not how great I am, but what tactic played out. Take a look at these trades in terms of how did that happen as you almost nearly forensically, definitely technically, but nearly forensically look at your tactic of low engagements. right? With what? With coverage underneath. I always talk about heavy cash reserves. Always, always with heavy cash reserves, never overexpose at any specific higher price. And the takeaway here is going to be that between the $50,000, between the $160,000, there's always going to be reserves behind you. The most dangerous thing, and let's look at one more technical issue here. But the most dangerous thing is the trader who gets involved. You guys know at this breakout here and wants to make this kind of money at high leverage, or this kind of money at high leverage, the 50 grand or the 160 grand, and they're only looking one direction. You guys know that's when panic sets in. That's where you can't tolerate it. And that's where the exchange is going to come and pick up your bucket of cash and take it for themselves. Likely. You guys know that. You're a sitting duck. So in terms of this, wanted to just explain. And we kind of started a little bit with the descending triangle turning into that bull flag. I love descending triangles. Why? Because the whole market is looking down. Right? What do we hit that 23.6 and all of a sudden, wait, it's a perfect bull flag. Right? We call this a double bottom single pass through. We call this a blackjack. That's just it. You guys know that double bottom. We got the single pass through. Why blackjack? Because the double bottom, the single pass through. Yeah, and that's blackjack. Double bottom, single pass through. Boom, to the upside. So I want to just make this video for anyone who is looking for how can you trade a bull flag? Can you trade? And we finally got to this point, and I did say you guys can review the tape. We finally got here, and I said this could be a good breakout trade. You guys remember that? I did say, and I rarely say that, but I said it just could be a good breakout trade here. Now with a stop loss, no problem. And if I had another account set up, we might have gone ahead and traded that as well. But right now, I really like having this information to present to you as an example. Okay, not of how great I am, but on each of these moves into the bull flag going up, hundreds of thousands and yes, millions of dollars can be created buying low, capturing value, buying the dips on a bull flag. Yes, on a bull flag on the way up. And when you do it, it feels sweet. I want you guys to understand what it is, okay, to capture value, to have orders stacked below, right, to never be overexposed at any one position. Then the market's not coming to take away, they're coming to pick up. Right, so this is London with MarketHedge. Soon, I'm going to say within the next week, we're going to have an upgrade to MarketHedge. We're going to be able to actually host you guys in the back. We'll be talking about a lot of these principles. But as you look at big-time fallout, people who are overexposed, I want you guys to know better. I want you guys to know specific tactics and techniques that nobody else is even talking about. No one else is even going to mention, right? And at this level and beyond, and we have the beyond, I have that slated to come in here through 2025, but you're just going to be so far ahead of the pack that it's going to be a pleasure to watch you guys harness this information and really get going. So this is London. Shout out. Hope you guys had a great weekend. Technically looking, are we at some resistance? I guess we are. Are we at the full line top resistance here? Take a look at your weekly. Look at the preceding video I did in terms of the standard deviations on the weekly and the monthly for Bitcoin. But as you look at this level across the top here, we're good on the lines, right? We're breaking this on the weekly. Yeah, we sure are. Okay, take a look at this on your chart. I gave you a weekly kind of read in last video. You'll see from this specific. From the pivot to pivot, we're up and out trying to break through that line. I want to encourage you, though, to take a look at the wicks. Take a look at the candle wicks. The story gets a little more complicated. What do you guys think? A little bit more complicated in that what? Nothing other than the fact that we kind of have a level of resistance incoming. Nobody wants to talk about it, right? But can we get, as you're looking at trading, as you look at, I'm just going to say your shorts, and again, never overexposed, not to mean you guys see my bull flag trades, definitely not a bear, but if you can get some agitation, you can get some sweet swing trades. And just the same thing, guys, same thing as the bull flag, you're going to be buying in, you're going to be stacking lower, Remember this bear flag. You got it right. What were we doing? Stacking higher. Boom. Beautifully well done. So let's see how Bitcoin does this week. International tensions seem to have calmed down. I hope you guys are doing well. And if you followed the trades here, I just hope that you've done well with always trying to buy the value, always getting into positions where, frankly, guys, we've just been really, we called this bull flag straight up and out. And I'm excited if you guys made some cash. So way to go. This is London with MarketHedge.pro. We'll be with you soon here throughout the week. And you guys just take care of yourselves, your friends, your family. We'll talk with you soon. Take care. Bye-bye.